Let me say that what I know a little about in Europe is the banking union. But the banking union is not created in a vacuum. It is created inside a whole process that you have described very well, in fact, of convergence inside the European Union. So let's begin the story with a very simple question, which is, what is the objective of the European Union? Why was it created, and what do we want to do with it? Because initially it seemed that it was enough to lift the barriers to commerce and open the frontiers to the movement of goods and services. But maybe the goal should be farther superior than that. There are people that say many times that what we're looking for is for an internal market with freedom of movement of people, capital, goods. And actually the goal is a little bit higher than that. If you read the Lisbon Treaty, it talks about the following, for example. It says, to promote peace and well-being of the Union citizens, to create an area of freedom, security, and justice without internal frontiers, to create a free single market. These are very much stronger objectives than just economic objectives of creating a single economic market with freedom of movement. So I think this is a very important starting point, because in some sense what you're trying to achieve will determine the way you do it and the instruments you're going to be using, and the complexity of the process that's behind. And the milestones in this process, you also mentioned this, it starts in 1957, in fact, with the Rome Treaty, or the Treaty of Rome. And you must think, of course, that 1957 was a completely different world than we have today. You talked also about the openness, more or less, of countries. 1957 was a year with no globalization. Was a year where you could do a lot of policies, internal policies, without having the problem that external influences or market influences were going to accelerate the process. It would be impossible to think today of lifting slowly barriers in many countries in the world, because the barriers just tumble down. There are so many ways to integrate that this is very difficult. But we had to wait 30 years from that beginning till we had a single European Act of the Single Market. And 12 years from then to the introduction of the euro. The process is accelerating. After the introduction of the euro, and only talking about what has to do with banking, you had talk about convergence in banking, a European system of financial supervision, which are what we call the ESAs, the EBA, for example, the European Banking Authority, of which I am part. And finally, in 2012, there was this proposal for a banking union. And one of the parts of the banking union, which is the single supervisor, will come into force the 4th of November. I actually asked myself last week, why the 4th of November, which is a Tuesday? Why start a Tuesday? And it happens that it's 1 year after the coming into force of the law. That was the 4th of November of last year. So anyway, so having said this, this process towards the banking union, at least in the Eurozone, and this is something I'm not going to go into because I think it's a particularity that it's not generalized, but you have to understand that inside the European Union there are about 18 countries that have a common currency and 10 that don't. So when we talk about banking union, we're only talking about the Eurozone. And as I said, this is part of this bigger process. But this bigger process, for example, started with a decision. Once the European Union decided it was going to go beyond a single market, the decision was, what do you want? Do you want a federal state, or do you want something different? And initially the decision was, no, we don't want a federal state. We want a union of independent countries. Now you find out what the difference is, but there are big differences between these two things. So We needed to put into place a number of elements to be able to move towards this union of independent countries that could fulfill the goals I have been talking about before. For example, you have to move power towards the center. The countries that are members of this union have to lose sovereignty and move it towards the center. And you need institutions. You need in the center institutions that are able to move this forward, and you need decision processes that work. And this is very complex. You have 28 members now. You have each time more complex activities that you are dealing with. And we all know that the decision process is not the best, and it's cumbersome, and it's very difficult and very complex. And you also need convergence. And both of you talked a lot about this. You need convergence in the European Union in general, but you need especially convergence in the Eurozone, because you also need economic convergence, because it's very difficult, if not impossible, to have a European Union with divergent economic situations in the member countries. In banking, we have lived two types of convergence. One is regulation, legislative conversion. And what happens inside the European Union as a whole is that there are directives and there are regulations that are regulating the whole banking system and the financial system in general, with the goal of having a single rule book for the whole European Union. And that makes a lot of sense, because if you want a common market, a unified market, you need the same rules of the game for all the players in that market. You need consistency across the 28 countries. And you also have institutions, in this case EBA, the European Banking Authority I mentioned before. These institutions that are able to have secondary regulation closer to the regulated. And then the second type of convergence we have here is supervisory convergence. And in supervisory convergence, there's been a lot of work through what we call colleges in banking, which is no more or no less than the meeting between the supervisors of the head company of a bank, or the parent company of the bank, and the supervisors of each of the subsidiaries if they are in a different countries. So it's host supervisors meeting to supervise a group. And then we have the single supervisory mechanism. That's another way of supervisory convergence, even though it's only in one part of the European Union. So, having said this, also another idea is, there was also said before, is that, and I think Linda said this morning, at least I think I thought he was going to say this, that the crisis we have been living in, we're still living in some sense, has been a catalyst of more union inside the European Union. I remember in 2008, 10 years after the single currency, the European Commission issued a report saying how successful the euro was. It was a huge success. And the only problem they saw is that there was some divergence in the economic situation of the members of the euros, or some of the members of the euro. 4 years later, we were involved in the biggest sovereign risk crisis we have ever experienced, and the euro was close to bankrupt. There was a moment where people were already thinking the euro was going to disappear, or at least some countries of the European zone were going to leave the euro. This has not happened, but the crisis allowed us a reassessment of what we were doing, looking again at the institutions we were using, and it allowed us a lot of more convergence, and in areas where we thought we were never going to converge. And one of those areas was the banking union. I mean, if you asked me 2 years ago, are we going to ever have a single supervisor in Europe, I probably would have said no, or at least I won't see it. Well, I've seen it. So, having said all this, what are the lessons and challenges we can obtain from everything that has gone on? First, that a European Union, or a union that goes beyond a common market is possible. It is possible, we need sufficient political will to bring it ahead. And it is possible even among countries with different languages, which is a huge problem in our relations, with different cultures and different religions. We've done it, it's possible, it can be done. Is it easy? No, it's very difficult. Is it a short process? No, it's a long process, but it's possible. And what does it imply? It implies losing power, it implies some central decision mechanism, and it implies a balance that's both institutional balance and it's a balance between the center and the independent countries that make up this union. And this balance is not easy, and it has not been reached always. There's a tension there, that sometimes it's a creative tension and sometimes it's a destructive tension. It's very difficult to regulate, and everybody knows this. There are jokes about Euro bureaucrats and how long it takes for us to legislate, but we've done it, and we keep legislating, and it's moving ahead, slowly, sometimes going back, but it's moving ahead. Second, I would say a monetary union is also possible. A monetary union that has common monetary policy, a common central bank, and a common currency. It's also possible. Is it more difficult than the union? Yes. It's more difficult because you need additional conditions. One of those is economic convergence. And that's the Stability Pact, etc. Now, is it possible, and I think you asked this in fact, is it possible to have a monetary union without having a banking union? Can you do monetary policy in a centralized way and do banking supervision in a decentralized way? The ECB has always said no, that's not possible, and we should move towards a banking union. But that movement, it doesn't matter how much, how necessary it was not possible without that political will I was talking about. And that political will was not possible without the crisis. The crisis was the one that allowed for this to really be possible. Now, a banking union is not only a single supervisor. That is something also that has to be made very clear, and that's one of the challenges we have today. A single supervisor is a necessary condition, but not a sufficient condition for a banking union. The reason is very simple, and the reason is who pays for problems in a bank. So you cannot have a separation of responsibilities in which the supervisor of the bank is the ECB, but the one that pays the cost of the crisis is each country. Because no government and no taxpayer actually would be willing to pay for something it is not responsible for. So the banking union requires not only the single supervisor, which we will have in a week's time, but also a single resolution mechanism, which we also will have. And probably requires a lot more things. Maybe it requires more convergence in fiscal policy. Maybe we need to deal with these unresolved tensions and difficult decision process that we live with, but this, on the other hand, seems a fact of life. I mean, this is the way history has done things, and if you look back, you could say that there were ways to do this easier and more efficient, but that's the fact that this is how it is. This is what we have to live in, and it's not so bad. And especially it's not so bad because in this last example, which is the banking union, it has taken only 2 years to put this in place, which is a huge, huge success. Thank you very much.